Okay, so how do you, really cut through all the market noise? How do you get those key insights, those aha moments that actually tell you something useful, especially when you're tracking an investor like Cathie Wood, who gets so much attention? Well, that's pretty much our mission for today. We're diving deep into her recent investment moves. We've gone through the latest market analyses, looked at her recent buys, and we want to pull out the most important nuggets for you.
Yeah, and what makes this timing kind of interesting is that, well, a lot of people see this as almost the perfect setup for her strategy. It's where her approach as a growth investor really comes into its own, particularly when these high beta stocks are climbing.
High beta stocks.
Right, the more volatile ones, the ones that tend to really move sharply when the market moves. That's sort of her playground.
Got it. Okay, so let's break this down. We're zooming in on 3 stocks she's been adding to: Nvidia, DoorDash, and then one that honestly seems a bit surprising: Nextdoor Holdings.
Yeah, that last one's definitely intriguing.
Exactly. So we'll dig into each one. What makes the buys interesting? What clues do they give us about the market right now? Right, let's start with the big one. Nvidia. Probably fills up your news feed, right?
Right.
The AI giant, look at the long run, it's kind of incredible. A 15-bagger over 5 years.
Yeah, 15 times your money.
And an 8-bagger over just 3 years. And more recently, shares have jumped, 67% since hitting a low point just 2 months back?
Yeah.
That's serious momentum.
It is, but if you pull back just a little, let's say the very short term, it's not quite as explosive. It's up maybe a pedestrian 10% over the whole past year.
Only 10%.
And like 8% just since the start of this year, which, sounds slow, but in the grand scheme, for one of those magnificent 7 tech stocks and the country's second biggest public company by market cap. It's actually, well, a relative victory. Shows some stability.
Okay, that's fair. But it hasn't exactly been smooth sailing this year, has it? There have been bumps. Like that news back in January about the Chinese AI startup, DeepSeek, using older Nvidia chips, supposedly getting great results for less money.
Right. That definitely made some waves.
And then you've got the whole trade war restrictions thing, hitting chip sales to China, leading to billions in charges for Nvidia. That sounds pretty serious. So given those kinds of headwinds, why keep buying? What's the thinking there?
Well, that's exactly the point, isn't it? The answer, really, it seems to lie in the fundamentals, the underlying strength. Because despite those headlines you mentioned, the real picture, you could argue, came out in their latest quarterly numbers. Revenue just soared, 69% to $44.1 billion. That actually beat what investors were expecting, which was more like 65%.
Wow, okay.
And the key driver, data center revenue, that surged 73%. It's now, get this, more than 88% of their total sales.
88%? Just from data centers?
Yeah. And adjusted earnings, up 57% to 96 cents per share, also better than forecast. And here's the thing, even knowing there's this implied $8 billion revenue hit coming from those export controls, analysts are still raising their profit targets for this year and even out to fiscal 2027.
So the analysts aren't too worried long term?
Apparently not. And look at the valuation. It's trading for 34 times this year's projected earnings and 25 times next year's. Now, given how fast they're growing, that's arguably a discount. Yeah. And think about this. Investors who jumped in back at that April low, they basically got in at what's now just 15 times next fiscal year's profit target.
It's 15 times. That's quite different.
Exactly. So it suggests Wood isn't just reacting to, the latest headline or a quarterly dip. She seems to be betting on Nvidia's, almost monopoly position in that core data center AI tech, seeing these other issues as maybe just speed bumps.
Okay, that makes sense. Looking past the immediate noise.
Yeah.
All right, let's shift gears. DoorDash. Now, this one seems to defy logic a bit, doesn't it? You'd think with economic worries, people would cut back on restaurant meals and definitely cut back on paying extra for delivery. Is that just wrong?
Well, it seems logical, right? But DoorDash has pretty much flipped that assumption on its head.
Yeah.
Their revenue rose 21% in the first quarter.
21%. Wow.
And total orders are up 18% over the last year. And remember how everyone worried about profitability when they went public 5 years ago?
Oh, yeah. That was the big question mark.
Well, guess what? They've now been in the black for the last 3 quarters. That's a pretty significant turnaround. And they're not just sitting back. They're making their own luck, branching out beyond just restaurants, groceries, convenience stuff.
Right. I've seen that.
They've also really improved their delivery fleet, making things faster, reaching more areas. That helps keep customers happy. Plus, they've been smart with acquisitions, buying Deliveroo in Europe and that restaurant booking service, SevenRooms. just this year.
Expanding their reach and services.
Exactly. So DoorDash really tells us something about, well, how fast consumer habits can change and how some businesses can be surprisingly resilient, maybe even thrive if they adapt.
Unexpected resilience.
They like that.
Okay, now for the third one. The one that maybe made me scratch my head the most, Nextdoor Holdings. I mean, most people probably use Nextdoor or know someone who does, but I bet many don't even realize it's a public company, right? That hyperlocal forum connecting, what, 46 million weekly users?
Yeah, it's kind of flown under the radar as a stock. It went public through a SPAC 4 years ago, a special purpose acquisition company.
Yeah.
And honestly, since then, it's been, well, a bit of a dud.
A dud is putting it mildly, maybe. Shares are down roughly 80%.
Yeah, it's been rough. Plummeted.
And the financials seem to back that up. Revenue growth, it's really slowed down. Hasn't even hit 13% growth in any of the last 3 years.
Yeah.
And profits, still waiting. They get to turn profitable. So why? Why would Cathie Wood, the aggressive growth investor, be buying this? It feels like the opposite of her usual play. What are we missing?
Right. It definitely makes you pause. Because on the surface, it doesn't fit the mold. But here's the counterpoint, and it's a big one. Despite the struggles, Nextdoor is sitting on a pile of cash, flush with $418 million.
$400 million. Wow.
And that cash makes up about 2/3 of its current market cap. Think about that.
Okay.
And crucially, no long-term debt. So you're right, a value play isn't typical for Wood. But she's been buying it up, building her position aggressively over the past 2 months.
Aggressively. So she's not just dipping a toe in.
Doesn't seem like it. So what could be going on? Well, maybe she sees it less as just a struggling social site and more as this cash-rich entity that's just waiting for a spark. Maybe there's potential in leveraging all that hyperlocal user data differently for a new revenue stream. Or maybe it just looks really attractive as a takeover target for a bigger company. Buy the users, get the cash thrown in almost for free.
So it could be a strategic positioning. Betting on a future buyout or a big turnaround using that cash.
Could be. It suggests she might be looking at value in a different way here, beyond just the immediate growth numbers, looking at the balance sheet strength and potential future moves. Hashtag, have outro.
So wrapping this up, what does this mix tell you? We've got Cathie Wood buying into, well, a tech titan like Nvidia, betting on its long-term AI dominance despite some bumps. Then there's DoorDash, the delivery company. It's surprisingly profitable and growing. And then this curveball, Nextdoor. Struggling growth, but loaded with cash. It's quite a diverse trio, isn't it?
It really is. And it leads to a pretty provocative thought, especially about Nextdoor. You know, given her reputation, Cathie Wood, the aggressive growth investor, putting significant money into a company like Nextdoor. Slow growth, stock's been a dud, but it has all that cash. It really makes you wonder, is her strategy evolving? Is she looking beyond just pure growth metrics now, or does she have this unique, maybe longer-term vision for how value gets unlocked there, perhaps seeing potential in that cash or the community itself that others are missing? What do you think that vision might be?